A little bit of a down day today. Kind of didn't get me into trouble, of course, didn't get me into trouble at all, but it was not what I really wanted. Caesars, I wanted to be a little bit more. I didn't want to see this downdraft. I'm okay with Kraft Heinz because we had a call sold against that. These are my married puts, by the way. LTH, actually, I sold out of. Let's go ahead and clear that out on my watch list here and remove that. That's good. And Planet Fitness has been taking a dive. It's lost probably almost $10 or so in the past 2 weeks. But that's okay because I've got the married put protection on it. We had a call sold against it that we actually closed out earlier as well. But AGI was an interesting one. I did something new with that. Not new, but I did something that we follow with the married put approach. So a lot of times, you enter a married put position and we buy a put following the rules in the blueprint, of course. That's 5 to 6 months out in time. Protects the position to single-digit risks, and then we sell calls, income method number 1, sell spreads against it, income method number 5 and 6 perhaps, and use the put as our second working asset on the position. Now, let's just take a simple view here. Let's just go to the search, their default search. This is where 90%, 95% really, of the married put positions that Ernie and I post at the Fusion portfolio at RadioActiveTrading.com in our personal accounts. And AGI is still in here. And this is the position. It dropped $1.40 today. It's down to $38.90. I could do a 41 put out to June, 153 days, or 8.5% at risk. Worst case scenario. Now let's take a look at Alamos Gold, the married put that showed up here. Let's go to just the profit and loss chart for this position. And of course, as you'd expect, the standard hockey stick graph, we've got a controlled limited risk of only $380 on an investment of $44.80. This cannot be violated like a stop order. AGI, if I open this position on Monday, or if I open this position before the close today, I bought the stock at $38.90. Paid $5.90 for the 41 put. Well, I do have a cost basis and a break even of $44.80 per share. But that's all the way out to June expiration. I'm not concerned about that. If the stock moves up 50 cents on Tuesday when the market reopens, I'm still going to be at a 25, 30 cent profit. That's not my goal. We're leaving the upside open. We're sort of flipping the covered call to where we have a limited risk instead of a capped gain and an unlimited upside profit potential. Now, of course, and the first thing you say is, well, okay, you open this position, Mike, that's great. You want to get some income to pay down this cost. You just simply sell a February. It only offers monthly options, but we could sell a February, and I want to sell a 41 call for $1.45 and cut this risk down on the position. Okay, that's all well and good. We got about a third of the risk down. We're down to 5.4%. 235, but it puts me in a position where I have an upper and lower break even. Naturally, I always have the lower break even due to the maximum risk on the trade. But we include an upper break even. Why? Because that 41 strike, even though we collect the 145, is now below our total cost basis for the position. So yeah, we got a nice profit here, 4.7%. The stock's trading right at 41. That's great. We've reduced the risk down to 5.4%. That's fantastic. But as the stock starts to move up here, what happens? Well, what happens is our call, 41 strike, that we sold has a negative delta against us, and it's going to a negative delta of 1 the deeper and deeper it gets in the money. It's negating the positive delta that we had on the stock and the put to begin with. Because the put was originally around a delta of maybe only 0.4, 0.45, somewhere in that range. Maybe 0.55, maybe 0.6. But as it's going up, the delta of the put is dropping. The delta of the call is increasing, and that's a negative to us, so it's countering all the gains. Kind of looks like a calendar spread if you think about it. Right? It does look like a calendar spread. So that's kind of why we don't sell the call right away, but that's kind of the idea. Another reason why I wouldn't want to sell a call right away in this scenario, if I just opened the AGI married put at this time, is because, let's go here. I'm going to go to stock research. These edit more information buttons are your friend. They can get you into deeper research, analysis, company news, and much more. But I want to go into stock research. or we were selling the February series, and on February 18th, although it's unconfirmed right now, but around that time is when the earnings are expected to come out. And our expiration was the 20th of February. So most likely the earnings are going to come out for AGI before that. I don't want to cap the upside in this scenario. This would be income method number 1 in the blueprint after you open a married put. But you want to wait for the stock to move before you do this. You want to maximize the premium, what we call the at the money bell curve. But okay, I did this. I've got earnings coming up. I've reduced my risk slightly from 8.5 down to 5.4. That's not slightly, it's a fair percentage, 20 to 30% or so. And I've got a capped return at 4.7 with earnings likely coming up before the February expiration. Another income method I could use is income method number 6. It's a bear call credit spread, but done in the context of owning stock. I sell this February 41 call at 145. I want to leave the upside open, so I'm going to take about half of that premium. It's a little bit farther than I want, but I'm going to go with a 44 call, ironically. Now, that's a wide bid-ask spread. There's no guarantee I'm going to get it at 58 cents with a bid of 15 and an ask of $1. But considering this is at 93 cents, okay, this is at 65. So we're going to call this 75 cents. A little bit between, but about exactly half, close to half of what I paid for the received for the 41 call. That's how I look at income method number 6. I'm going to take half. So we're going to call this 73.74 cents. I'm going to add that into our tool here, our custom spread tool. Let's buy this at 73 cents. 73 cents. I'll go a little bit more than half with that wide bid-ask spread. Now, does this take away from my premium? Yes. Is this going to take the risk and move it up from 5.4 to about 7.1 because I'm taking half off? Yes. But what's going to end up happening, I still have that capped gain. I have that risk of 7% because I added more in. And I have this little heartbeat here between 41 and 44. But if it exceeds expectations, now I've left the upside open. That's income method number 6, doing a bear call spread. While owning the stock position, I still get that sort of covered call view because I have my capped gain. But at the same time, we leave the upside open with that extra long call, and we still generate, 70 cents, 72 cents a premium to reduce the risk down from 8.5, which it initially was, down to 7%, not the 5.4%, which is a little more attractive going into earnings. But that's the case. It leaves the upside open. Now, what is my position on AGI? What did I do to synthetically create this without owning the stock after I allowed assignment with just the income method number 1? So just having an income method number 1, but it was at, I think, the 38 strike, if I'm not mistaken, instead of the 40 strike. But, I had just sold a call against AGI at the 38 strike, and it went up to 40, 41. I think it was 40, 60 is when this happened. So I allowed the position to be assigned. I didn't pay the $2.60 to buy back the call and then roll it further out in time. I just let it be assigned. I'm still holding the long put, but my put is different. It's in May, if I'm not mistaken. And rather than buy the stock, take assignment, buy the stock back, and then do an income method number 1 or an income method number 6, I have it's the March, not the May, apologies. So I have the March 36 put now. It was the 38 call that was assigned. And what I did on December 26th is we sold to open a January 40 put against our March 36 put. This would allow me to potentially get back into the stock at $40 per share. We went right at the money, again, maximizing the ATM bell curve, one of the 3 core principles of radioactive trading discussed in the blueprint. And I got that for $1.25. And then, similarly to what we were just looking at, I bought the January 44 call at 60 cents. What did that do? Well, essentially, I have what? A calendar put spread. I own a March 36 put with a negative cost basis from the profit on the previous position getting assigned. Sold the January 40 put at 125. That's the calendar put spread. But then I took half of it and just bought a long call, which gives me what? The synthetic income method number 6, in a sense. So we have a total net credit of $3.29 on this position. The maximum risk is 71 cents. Well, if I have a net credit on a debit spread, a calendar debit spread, how can I have any risk? Because the cost is $3.29, the difference in the strike prices between my sold put at 40 and my March put at 36 is 4 points. I had to put up the 4 points to cover that difference in this case, even though it's a calendar put spread. Because it's done at a credit, because we've lowered the cost basis from the previous profits of the married put position when we own the stock. Now, let's take a look at the stock chart. Best opportunity. So what do I have? Again, I have a capped gain here, a little bit of a decline between my sold put strike, similar to if I had the stock in a sold call, and the long call extra strike I paid for. But then I have unlimited upside if the stock continues to run. Remember, this was done on December 26. Merry Christmas to me. Let's take a look at the chart. Now, there's been some ups and downs, and today was down, and gold has had some other hiccups, but let's just isolate this chart. I'm sorry, it's from around December 26 to today. So let's scroll back here. Sorry for the scrolling, folks. Perfect. So December 26th, that's that price. We were at about 40.60 when this income method was entered. And it had a drop here, and it dropped down to 38.90. I wasn't worried. And then it increased and increased and increased and increased. 3 or 4 days ago, on the 14th or the 13th, let me jot that down. This is when I should have rolled the entire position. What do I mean by that? The stock was up here at around $42, $43 per share, which means my 40 strike put was only at about 20 or 30 cents to buy back. Remember, we collected $1.25 from it, so it would have pocketed about $1 on that position. Our 44 strike call wasn't at 60 cents because it's only 2 or 3 days to expiration, but it had a value of about 30 or 40 cents, so I could have gotten that back from that call as well. And I didn't, because I figured, well, if it goes up to 43 and then it goes to 43.50 and then it goes to 44 by expiration, I'm exactly where I wanted to be. And this synthetic new income method that's going to be included in, it's not a new income method, it's going to be included in the income method number 7 chapter. But this version of income method number 7 with an income method 6 twist, stocks at 43.50, 44, 44.50, exactly where I wanted it to be. Okay, I wanted it to be at 50, but that wasn't going to happen. But hey, gold has silver been on a tear. It had to pause. It paused now. But that's okay, because the end game was I'm still bullish on this position long term. I still have that put out to March, which I can roll up, or I can roll up and further out in time to continue this trade if I feel gold and silver continue, even though we're seeing red, even though we're seeing a negative MACD crossover right now. That's okay. What I decided to do is I missed this window, got greedy, not the worst thing in the world to do, but got a little bit greedy and decided to stay in. Then we had the drop. Yesterday it was flirting right around 40, right around my strike price, and today we had that other big red drop. So I'm going to take assignment on this position, is what we decided to do. Rather than roll it to another February short put at probably the 39 strike, most likely the 38 strike, and then buy a 42 or 43 call to continue this pattern, the synthetic income method number 6, which would have been bulletproof, by the way. I decided at this point just to let it be assigned. So we're going to take, with a negative cost basis on our put, we generated an additional 65 cents of net credit. So that's going to put our negative cost basis on our 36 put down to 329. So let's change that first. factor in the profit we took. We have a negative 3.29 cost. Whoop, that was an extra button, wasn't it? Extra 3.29 cost basis. We're going to add stock 100 shares at $40 for assignment on the put. The transactions of the short call, the short put and the long call were taken into account into our cost basis, negative cost basis on a 36 put. Let's go ahead and submit that. Let me clear out those drawings so we can see it a little bit better. And I have a risk of 1.9% now on the Alamos Gold trade. Earnings likely coming up on February 18th, I apologize, February 18th, at least before the February 20th expiration. So what can I do? Well, now I can do the actual income method number 6. So for February, I'm probably going to sell, my cost basis is 40. So I'm probably going to sell the 41 call here. Might get $1.80. We'll see what happens on Monday. And the half again. So I'd probably go here, 183 to 93. So I'm going to go to 40 to the 43. This might not bulletproof the trade in this scenario. Now it does. It just gives me a 0.5% bulletproof status through earnings, worst case scenario. Max return or return at the peak here at $40 if it starts to recover of 401, more than a 10% return with a cost basis of 35.81, and unlimited upside if the stock moves up. And of course, I have this second working asset in my favor. It's already a negative cost basis of 329 from the other adjustments and income methods I've done. I can use this. It still has value. It's out of the money. 36 doesn't have a lot of value, but there's still some value in here. I can roll this put up. Income method number 4. Let's sell to close the 360 at $1.50. Then it showed us the 41. It showed us the 41 for June. But let me just roll up here to the 41. So what am I doing? I'm going to get 150 back for this put that I already have a negative cost basis on. And I'm going to pay 440 for this 41 put. Essentially, I'm paying $290 to gain $5. And I actually don't like that. Is my math wrong? No, my math is right. I'm paying $290 to gain 5 points, and I don't like that. When I use income method number 4, I want that ratio to be about 50%. I want to pay $250, maybe $260. Sorry for the drawing there, folks, or $260 at the most. I want this debit that I pay to be less than 60% of the increase in profit. So I'm moving up 5 points, but I'm paying $250 or $260. Paying the $290 here is a little bit hard to swallow. I don't like it. But at the same time, I had a negative cost basis on this put to begin with. So let me see how that pans out. We're going to sell to close our 36 at 150, buy the 41 March at 440. So that's going to be our 290 into the position. We increase the bulletproof status, but that dip gets a little bit stronger. But again, I like it. Bulletproof status of 5.9%, better than 0.5%. So if Alamos Gold earnings collapse, even if it drops down to $26 per share, I'm guaranteed 6%. Peak here is at 400. No, it's at 357 with a cost basis now of 38.70. So I'm below 10% at that peak, but I left the upside open. Now I'm not expecting Alamos to jump to $46, $47, $48 per share. And that all depends on where it is anyway, and that's 20 to 25 days away anyway. But I like that structure. No red, guaranteed 6% profit on the position. Versus, someone just mentioned this is why not just take it off the table? And that's valid. I could take it off the table now, liquidate the position. Now it'll be a 457 profit, but remember, I'm taking assignment on the stock, so I'm still above 10% at that point. This is usually when I stop and say, Mike, just take the 10%, take the 11% and move on. But we'd be making $457. We're going to have $40 invested in the position. We saw that initially without, all this other foo-for-all that I just did for the income methods and how powerful they can be. But I know it's a lot of math. But just taking assignment on this at right now, I still have a risk of 1.9% going through earnings, but the upside is open. So the comment is valid. Why not just liquidate now? And I balance that. Liquidate now, 457 would have been above a 10% profit with what I have now. Roll the put, because I did that synthetic income method number 7 with this. I did the income method number 7 in the blueprint and then added the twist to it, that income method number 6. Now, that's going to be included for you blueprint owners. You're going to see that in addition to 4 different addendums, full almost half chapters, but addendums that are coming out on when and how to use income method number 4, income method number 9, exiting the RPM position, and another twist that Ernie has on a different income method. But this is my twist, the income method number 7 with the income method number 6 flair, for lack of a better term.